Hello, welcome to our Instagram. My name is Andrew Kuhn. Focus Compounding, sitting next to Geoff Gannon. Jeff, say hi to the camera.
Hello, camera.
Hello, camera. In today's video, we just got done recording about, 3 different podcasts? Mm-hmm. And in today's video, we are going to be talking about the pressure that comes with, finding a new stock idea. Okay. And we talk about this often, how, you could look at 100 different ideas, and maybe only 3 could be potentially interesting. Mm-hmm. And that's okay, right? That's sort of part of the process. I mean, for us, if you're targeting 5 to 6 stocks, you're really able to, wait for the true fat pitches or the true, companies that you think are just incredible, and you don't have to settle. So maybe, what do you do to sort of mitigate, the psychological biases that come with, the challenges of looking at a bunch of companies and being like, I just can't find anything that looks interesting?
Yeah. So I mean, well. The big thing is if you have cash, that's a problem because then you feel pressure that you have to invest in something, or if you have a stock that you don't like that you'd want to sell and buy something else. The issue that you're talking about is basically you don't need to do that, but you're just tired of looking at a million stocks and finding nothing good.
Yeah,
and you
sure.
just get sort of down about that or whatever. Yeah, I don't have a solution to that problem. I mean, I don't really. We can do all sorts of things to screen differently, and we try doing that. We do all sorts of things to look for things that are people who write about stocks or whatever who might turn over more interesting ones, and that doesn't reduce the amount of stuff you have to look through that isn't very interesting. I mean, the number you gave of 3 out of 100, that was from Papaya had done one. He did an interview with Graham and Doddsville newsletter, the Columbia newsletter, where he used that number, and I'd say that's a pretty accurate number. I don't know if it's 1 out. I think I've said a lot of times maybe 1 out of 20 stocks is interesting enough that you actually start researching it in depth. Usually, you have to look at about 20 stocks to find one worth looking at. Yeah.
Mm-hmm. So what do you just continue just to search around? I mean, has there ever been a year where you did not buy one stock within the year, but the whole time you looked at hundreds of companies?
Yeah.
Really? What year was that? Do you remember?
I don't remember. To be honest, it was one of the best performing years.
Really?
That year and the next year were
so because the performance of the portfolio was one of your best.
It was actually good that year and the next year too. Yeah. I went almost 18 months or something without buying something.
Wow.
Yeah.
How do you mitigate against it? I mean, is it because we talk about this all the time. Again, everyone runs their portfolio different. So if you own 30 to 40 different stocks, it's probably easier to, waver and make smaller positions. But if you run a concentrated portfolio of 5 to 6 stocks, or you have anywhere from 20 to 25% in a single stock, you don't obviously want to waver on the type of quality companies that you're investing in. I guess there's some people, what they'll do is they'll do special situations, some arbitrage situations. You wrote about in the letter about how when Munger joked to Warren Buffett, how during certain situations we'll keep them out of bars.
Right.
But I think it's the psychological pitfall that a lot of people fall into because you look at so many different companies and you're still not finding anything that looks interesting. I mean, I really do think, as I'm, looking at screens and typing them to QuickFS, I'm looking at it from a bird's eye view. Mm-hmm. And really out of, I would say it's probably that percentage of the companies that look interesting to actually take a deeper look at. And we even have, a higher hurdle because the stocks need to be overlooked.
Yeah, they do have to be overlooked for us. One way around that is obviously price. So what you could do is just study any company regardless of price, and then hope that you have this watch list that eventually some of them will come down to a price that you buy. Because there are always companies out there that are really interesting and you can identify them.
Yeah.
It's just some of them are at prices that aren't remotely close to being something that you could pay for the stock.
And I think that's the best way to do it, to make your research process still productive, because you are learning. We talk about this all the time, how knowledge snowballs. So what I do is I have a watch list, an Excel spreadsheet where I keep track of companies that I've been studying, and then I give a price where I would want to revisit it. And I also leave a bunch of comments, just so I could get caught up. For example, if I haven't studied the company in over a year or 6 months or whatever, I could kind of get right back to it. And then it comes up on my radar again if it starts trading closer to its 52-week low, or it trades at a PE that's maybe less than where it was when I first looked at it. But I usually pick a spot, because you want to value the companies that you are looking at, because you want to make it as productive as possible. So even if it's trading at, let's say, a market cap of 700 million, and you say, okay, I want to revisit it, I think it would be interesting to buy this company if it were to fall to 500 million or 600 million. Then you want to revisit it then, But I think if you keep a productive watch list and a productive batting order, that will make everything you're doing worthwhile, you know?
Yeah, and the other thing that you can do is just you have to be kind of open in the very early stages of research to look at things that you might not otherwise look at, but you don't want to go too far with that. So things that might be that in some ways seem like an industry that you might not normally buy into, or that seem very speculative or whatever. So like, for instance, I don't really like retailers. I have to be somewhat open when looking at it to see if this is something that's very different from a normal retailer, you know, and give it a few minutes of looking at the idea to really consider that, because otherwise you might frame it in the wrong way and just assume that it's like everything else in that category you've seen. And that can happen with anything. It could happen with banks or something that you might not be willing to buy most banks, but you see something that's really different about this one. It's very easy to get too superficial a view at first and to just eliminate something. And then for us, probably the biggest one is it could be possible that we could overlook things that don't have good past results, but are going to have good future results. And that's a hard thing to do.
Yeah, and I think, I mean, there's a lot of investors, for example, what they'll do is they'll take what management's guiding in 3 or 5 years and say, well, relative to that, it's trading at 6 times earnings today. If they hit that.
Right.
And I think the approach that we take it, and if you listen to a lot of the way that Buffett thinks about it, is he wants a 15% return or earnings yield today that he feels comfortable is going to grow over time.
Right.
So I think that's the approach that we take, where we want to be trading, because like I said, there's a lot of other fund managers that's, you know, if you go on Value Investors Club especially, it's much more 2 to 3 years out. You know, they base it a lot on what management's guiding and if they feel confident that they can hit that. And of course that works for some investors.
Yeah, and that's the possibility of what you could do. I mean, we could spend more time reading investor presentations and things by management and looking at what their guidance is, what they think they'll hit in the medium term of 3 or 5 years or whatever, and base it on that. I mean, we're willing to look at guidance and stuff for companies that have already achieved some of that stuff in the past, but like a company that's barely profitable now but saying that'll be very profitable in 3 to 5 years is not something that we would trust in that when making the decision. You know?
Yeah, but again, that's just our process, because again, we run 5 to 6 stocks, so we don't
really
need a
invest in
waiver. If we had a 50 stock portfolio and we had 2% positions, it would probably be a little bit different.
But then you have to find 10 times. You have to find ideas 10 times faster.
Yeah,
because if you have the same holding period, let's say that we have a 3 to 5 year holding period or something, and so does someone owning 50 stocks. Well, then they have to find stocks 10 times faster.
Yeah.
So the problem is you still run into that problem.
Yeah, but I think the answer is, in closing, is to just stick with it. You heard Geoff say he went 18 months of just looking at a ton of different companies and he never bought a stock. So stick with it, make it as productive as possible, create your own watch list with your ideas, have a system where you can revisit it. Of course, if you are studying the businesses first, you are less likely to confuse a statistically cheap stock with a margin of safety, and I think that's the most rational way to do it. So I want to thank everybody so much for tuning in with us. Hit that follow button. We are going to be pumping out more content here on Instagram, and we will see you in the next video.